Hello and welcome to Trading with Technical Indicators. My name is James Boyd. Today's date, July 13th. Someone was asking about my weekend. My mother's 74th birthday was yesterday, so we did celebrate that. Busy week last week. My daughter left for 18 months to go to Indiana, so said goodbye to her. And it was a busy week. Taught something yesterday at the local church here, and very good topic. And so it was good times. A lot of good active participation yesterday, and we'll have that here today as well. Got Michael Fairborn in the chat. We welcome him here as well. Aloha back to you, Scott. Yeah, I need those Hawaiian shirts back. And I think she's going to like it. She's going to live near the Indianapolis area, and good for her. She's having a good time. Now, just real quick as we get started. Yeah, so it's just myself, my wife, my son. He lives in the basement, and really the dog. So this house most of the time is just completely quiet. So anyway, it's one of the joys of getting older, right? All right, a little fun there. But speaking of my investing friends, hello and welcome to you, Leminski, Gary, Josh Pink, Will, Eric, and many others. Welcome back. This is your first time. This is not a one-off session. We meet each week where we talk about trading with technical indicators. This week we'll talk about reversals and continuation. Now, we did have a question come in the chat regarding kind of managing a portfolio. We'll talk about that right off the bat. Now, just real quick, remember that Mike Fairborn and myself, we do post educational content on X. There's my handle. Mike will post his in the chat. That way you can just click on it and follow him as well. Now, just real quick, remember with what we discuss, the information we talk about is done for general informational purposes only. Also, remember when we talk about options, or if we do, remember that options carry a high level of risk not suitable for all investors. Understand that not all option strategies are the same. You should have an understanding of what the strategy is and what it's really trying to do. Also, when we talk about examples, we will do those in the Paper Money software application. When we talk about investing involves risk, including loss of principal, and it could also be unrealized gains. Throw that in there, okay? Maybe you're watching Apple here today, and you're thinking, man, that when it was up 6.5, it fell a lot better than $1. Okay, anyway, so more the story as it moves, right? Now, today we're going to talk about reversals and continuation. I want to actually hop right into one of the questions that was asked, and it was this one. And let me actually just maximize that so we could see that. There we go. Okay. Now the question was this, okay? JB, with the constant back and forth on Iran, how does one really manage their portfolio? Does one constantly rotate or go medium to long term and not bother? Do income and growth traders adopt differently? Okay. Well, so first off, if we're talking about where there's been volatility, now we got to actually say volatility in what? We had the initial drop, but since we actually had that initial drop, the market it's not the same. We don't have oil at 125. We don't have the VIX at 35. Okay. So and remember what I kind of said before is it's the initial reaction. When that actually happened, there was the initial reaction. And then the longer and longer it goes, the market just says, look, we already know about that. And sadly, the market kind of gets used to dysfunction. That's why the VIX is in at 35. Now, so when we actually talk about this, if you're actually saying, hey, look, I actually think there could be, there's that continuance. Well, with that, we actually know that we actually look at the four, right? We actually look at the crude oil, okay? And obviously, if we're actually kind of having some of that again to some degree, obviously crude oil, okay? Is there a crude oil play? Some people might like to say go long the crude oil. They might go long oil, also include the gas, but also maybe let's say the energy sector. Now, I'm going to asterisk this one about 50 times. If someone says, hey, we're in a period of higher volatility, they might say, look, I'm not going to do as many stocks in the short term. I might do a sector, an industry group, right? And so on. Now, the other thing actually with that is they might say, let's say stocks. We would also say with this, we would also say that if we have kind of that conflict to some degree, we might say, what is DXY? DXY is the US dollar, right? That US dollar, okay, some actually might investors say long. If they're long the US dollar, that actually means they're short, okay, another ... You fill in the blank. That's not what this class is, okay? Now, We got to also ask ourselves, is the VIX actually rising? Question mark. Not really. But the other thing we actually said with the four, and by the way, this is not new, the CGI, which is the 10-year, that actually has been rising. Okay. So we have rising rates to some degree. Now, what does the investor do with that? Well, they actually might say, well, wait, if the rates are maybe higher, could there be potentially products that capitalize on those rates? Any trade ideas in the short term with what we just talked about? Sure. Okay. Long oil, gas, energy sector, stocks. The one thing that sometimes people always think about is that they think that just when we talk about growth, that it's just technology. And that is not true. Okay. So when we have classified this, when we talk about growth, okay, growth, of course we would say tech, but that's not all. Tech, we would also include here discretionaries, okay, discretionaries, okay, discretionaries. We would also include with this energy and basic materials. These are probably the four sectors that if we have growth, like in terms of the revenue, earnings per share, ROE, things like that, percentile movement, up or down, it's probably going to be in those four sectors. If we said mid, okay, we would actually say industrials, transports, okay. We would also include financials here. Now, by the way, so here's the deal. If we're seeing a lot of this volatility hit some of these tech names, like the semiconductors, the investors cannot complain that much. Some of those tech sectors, semiconductors, they went up hundreds of percent. Okay. So it's been the same thing, which has been semiconductors have been softer. Some of these other areas like cloud and software have actually bounced back. Okay. But that's not the only area. I mean, when you think discretionaries, Amazon, right? Apple, among others, Starbucks, Target, right? Well, with some of that volatility, does that mean that, we can't look at energy? What's wrong with Valero? What's wrong with MPC? What's wrong with PSX that we talked about 2 weeks ago? They're still up and they banged a brand new high here today. So here's the thing. I am sick of people thinking that actually just growth is technology. Okay. There, I said it. I just got it off my chest. I feel so much better now. Now, here's the deal. Have materials really been that strong? Not really. Okay. The strongest probably area in there because of what's happened abroad. Fertilizers actually pushing back to the upside, CF. Gold and silver are under pressure, to say the least, as that US dollar pushes the upside. So someone said, hey, does someone just say, forget the shorter term? Forget the shorter term. Because of what's happening abroad, that's opening up some plays in the short term that are just not technology. All right. Now, James, calm down. Well, here, hold on. I'm not done. The big deal is when we look at, let's say, low beta. Okay. So let's just call this here income. Okay. So when we say this income, of course, we would say the healthcare. Now, I want to go to the healthcare for just a sec. Let's say staples. Okay. Utilities. Okay. And also, we are going to include, just real quick, real estate. Now, remember, if there is some volatility in the marketplace, does that mean that there's no short-term plays in these areas? That's funny. That's not true. Okay? Because there are some healthcare, United Healthcare, Cigna, among others, which we'll actually pull up in just a sec. They actually got some pretty decent moves. So what it really is people lock onto that one area of technology, but they don't understand that, discretionary could just be, among others here, it could just be, if we pull this up, and I'll do that, these other areas. So I think you have to kind of branch out away from technology. Now, here's the deal. If you draw this up as my platform is coming up, you got to understand something. If you put this right here, this is, let's kind of count this as percentile, okay, the percentage return, the forecasted percentage return. Okay. And on the bottom here, you put growth. Okay. So here's the deal. If you, for example, went technology and you put this in a grid, you are all the way up here. So in other words, if you said, hey, James, you're all the way up there. Now, if we buy some of these, let's say discretionary, which by the way, some of those discretionaries could be technology as well. But you got to remember this, if we actually did, let's say the growth, I'll put this up here, growth. That does not mean that they're all the same. let's say the investor said, James, I have 30% in the short term in the growth areas, 30%. And if the investor says, I have another, let's say 30% that's in the mid or let's say value-ish area, okay, mid, and I have another 30% that is actually in income. Now, who does this really hit? It's the investor that did it to themselves. Oh, I hate that talk on responsibility. But the moral of the story is I've seen it way too often where the investor has 100% in technology and they don't realize that's not the only game, that's not the only investment in town. So even if you said I got 30% technology, or excuse me, growth, I should say, that doesn't mean that it's all stacked in technology. Okay? Does that help? Let me actually see if it helps. And if it didn't help, let me actually see what we could actually talk about. But let's kind of hold that thought for just a second. Did that help? Hello, Riceberg. I just want to see if this helped. Now, what we're going to do is we're going to try to take what we just talked about, and we're going to fast fire through some of these areas and kind of see, well, geez, does that mean the investor can't trade short term? No, I think when you have the volatility, okay, that actually creates maybe more short-term opportunities. The also other thing we got to understand, if there's volatility, the investor might change strategies to try to handle the volatility. So if there's more volatility, remember we actually said before, is that if there's higher volatility, we might change the strategy. Okay, might change the strategy. Now, when I say that, that also might mean instead of doing tech as much, we might do, let's say, energy, okay, because of what's happening abroad. We also might say, hey, I might actually try to see if there's some opportunities in the mid area or income, even for shorter term types of trades. Now, could the investor do healthcare stocks in the shorter term type of trades? Could they do industrials, transports, financials in the short term type of trades? Sure, okay. It doesn't mean that short-term trades are only in technology. Okay. All right. Now, let's go to work now. For crying out loud, now that we just got that off my chest. Okay. And some of you are saying, I know he's just going to pop. I know he's going to pop, and he just wants to go there. Okay, I did. I have been wanting to say that for weeks. Okay. Now, here's the deal. How come no one asked me to tell me what I really think? Okay, here we go. Now, what I'm going to do is let's pull this up. Let's kind of talk about some of these areas, kind of fast fire the market a little bit. Now, the one thing we kind of have to say in just being 100% truthful is I call the SPX EW really like the real market. Real market meaning all sectors are 10% each. Well, actually, there's 11 sectors if you include real estate. So there's about 9% each, okay? If you look at this market, you wouldn't really think the market has really been too volatile if this equal weight index of the S&P 500 has been grinding to the upside. When this dropped down, this was the initial reaction of what we saw overseas. But since then, remember, that reaction became the potential opportunity. That's usually what happens. So when the volatility goes higher, it's not the investor put the head in sand or be a turtle and just put their head in the shell. When things go down in the shorter term, that is the opportunity where people tend to actually overreact because bad news, bad weather doesn't typically last forever. Okay? Now, so if we pull up the areas that will show this, the Dow, if we kind of look at this, same where we were last week, we pulled up the S&P, just the S&P, which is top-heavy technology. That doesn't look like it. Is that really that volatile? Maybe it's volatile on the 1-minute chart. Okay, we don't see the volatility on that chart. We actually pull up the Russell. That's the one that's kind of yanked back down to where the old breakout was. Super volatile? I don't know about that. It doesn't look that volatile, at least so far. Okay, now if you look at the NASDAQ, that's the one that's been more volatile. But you got to understand something, right? If we were on a roller coaster ride, okay, at Cedar Rapids or in Cleveland or whatever it's called, you got to remember something is when you go up, when the hill that we went up was 33% for the blasted index. Are you thinking it's only going to pull back 1% off the high? Of course not. Okay, it's probably going to pull back 10%. So far from the very tippy top, down to the very low of this pullback, we've fallen 8%. We went up 33, down 8. I mean, kind of what we're doing is kind of chiseling out some support levels, but I'm talking about from top to bottom after 33%, only 8% give back. Okay. So sometimes what we have to do is realize we're in the investment of stocks that are more volatile. Okay. And you might have to kind of say is, are you just kind of stacking all the capital, so to say, in just one sector, and then you're kind of realizing you're doing it to yourself. Okay. So I'm not really seeing what you're talking about. I'm just being frank. Okay. Now, let's kind of talk about some of this short-term area. Now, with that volatility, does that necessarily change, okay, that the investor can't do short-term? We wouldn't come away with that idea. Now, I want to kind of show some just real quick, and let's go to, let me fast forward around let's go sectors just real quick, okay? Now, with what we talked about on this previous sheet right here, okay? So if we kind of say, hey, there's volatility, things like that, well, let's kind of think here. Okay. Crude oil. These have been the four that we've been talking about for blasted months. Well, let's go look at it. If we got crude oil going to the upside, we know that there's some opportunities where the investor might say, hey, I might go try to trade oil long. Okay. There's ways to do that. Now, if you said, I just want to look at the sector, the IXE, well, there's been a little movement to the upside. So here's what we got to understand. We're in an economy where there's always dysfunction somewhere. Why? Well, because people run it. Why? Because nothing's ever perfect. If it was perfect, what would the opportunity be? The fact that there's dysfunction says there could be potential opportunity. Okay? So maybe have a new viewpoint of dysfunction. Okay? Now, if we look at the IXE, option number one, the investor might just say, look, I'm going to buy the sector. That's not what this class is. Second, if the investor says, I'm going to go look for maybe some stocks that are in that sector, like what? And that's when you type in the chat, what are some of those symbols in the energy sector that the investor might be looking at? Now, when we get the commodities moving, oil, that also might move the transports. We cannot say that transports have been extremely weak. I don't like this index, okay? I already said that. Go look at the one we talked about on Friday. But go look at the transports, okay? CSX, which has been that choo-choo train that just says, I think I can, I think I can, I think I can, grinding way to the upside. Remember, if oil is more expensive, diesel's more expensive, maybe they're going to rail that stuff to the end point, right? So transports. Now remember, if someone is so concerned about the volatility, Staples, they've actually held in there. Now you got to understand this, that it moves. Okay, it's moving up and down, but the movement up and down isn't crashing up, crashing down. When you look at utilities, that's also been kind of holding in there, moving up and down. Healthcare, that's the one that we're going to keep an eye on. We're going to show it examples of just financials. That's not been soft. Okay, and if you look at real estate, and again, you got to understand something. Is this really crashing up and down? And I'm going to look at this top to bottom. I'm going to try to see what you're saying. If I look top to bottom, this has been a 5% move up and down. Do you know what's crashing up and down? Someone's checking account. Go plot someone's checking account. You should do it, okay? Plot your checking account, look at the high recently, and then look at the low. And you'll see that the checking account is way more volatile typically than the stocks that we're looking at, typically, okay? Now, a little humor there, right? I mean, fair. Now, here's the deal. If we take a look at this, okay? If we were to look at some of these examples, I want to go just real quick to one of the stocks. Let's kind of go look at that area. So remember, we already said crude long. We're going to highlight that energy sector for just a moment, okay? Just a moment. Let's highlight that. I want to come back to that. Let's put a little blue there. We're going to come back to that, okay? The other one I want to kind of look at just real quick is that discretionary area, okay? And I'm going to highlight that. And I also want to look and see and we already said energy sector, okay? Now, the other area that I want to kind of look at is just also want to look at this healthcare area. And again, the focal point of what we're talking about is really reversals and continuation. Now, let's go to work, spend the rest of the time on just trade examples. Now, when we talk about some of these reversals, now, Here's the funny thing about people buying stuff, okay? Now, even if people have a lot of stuff, they usually want more stuff. You ever notice that? Now, that stuff that they're buying, one of the places is Amazon. Now, it's not just Amazon, okay? We've had Target that's actually had a decent move. And again, it fluctuates. They're stocks. They're supposed to fluctuate, okay? And we also have Dollar Tree, which has actually been on a little push. We've also had Dollar General on a little push. Okay. Now, my focus is going to be on Amazon, but don't just keep in mind Target, Dollar Tree, Dollar General. Those are probably in the four if we're talking about retail stores that we're typically talking about. Now, if we look at the area of kind of resistance on this chart, earnings coming up on 7:30, we got about 17 days, 2.5 weeks. You're also going to notice on this chart right here, really an area of resistance. Now, here's what we got to understand. If there is volatility, it maybe is the position size too big. Maybe that's what's going on here, okay? Is the position size too big, okay? Position size. Maybe is it dadgum too big? Are we doing it to ourselves? Second, dollar cost average. My gosh, we've hit that so stinking hard, okay? Talking about that doesn't mean people do it though. It's totally different if the investor did it. Dollar cost average. The other thing is strategy selection. Now, here's kind of where there's difference between, let's say, stocks and options, right? If the investor says, look, there's volatility and I'm just trying to sedate some of that volatility, well, there's lower delta strategies for that very reason. Okay. Now, let's say I said, hey, I'm this market's all over the place. I'm not sure if I completely agree with that. Okay. Sure. I'll just go with it. Let's say the investor said, look, I'm going to actually sell the put vertical. Selling the put vertical is trying to be a little bit more forgiving for price movement up and down. Con about that is, if I get the direction right, if the investor gets the direction right and it really goes to the upside, the investor is going to say, geez, I wish I would have just bought the shares. 100 delta if they bought 100 shares. Delta's sensitivity to price change on the stock. Stock goes up $1, we have 100 delta, profit loss, okay, plus 100 shares, $1 movement in the stock. Now, if we actually said, look, we're going to go down to sell the example given the 235, Steve, right? Well, what is that doing? Why are we picking that one? Well, if the investor is concerned about price volatility, they want maybe a strike that's lower to the current price, lower delta, lower sensitivity to price change. And what you're now going to notice is we might even do, let's say, something where the strikes might be a little closer. Okay. That way, if the investor was wrong, they're actually saying, look, I want something where if I am wrong, that the loss is less. Okay. So that's one thing. Now, here's the deal. You cannot assume volume or liquidity. You have to verify. When we go look at the 235, we got 20 cents wide. We got 15 cents wide. 235, 230. They're no wider than 20 cents, which is in the wheelhouse of what we normally talk about. Now, what I'm going to do is I'm going to go to the mid price. I'm not going to do the 230. I'm going to see if I can't open this up to the 225. The 225, verify with eyes. Okay. 15 cents. Dean, stop looking at MPC. You're getting ahead of me, Dean. Now, here's the deal. 225. I'm coming to the oil. Now, if we look at, let's say, the 282, there's the credit there. Let's just double check, okay? So 282, yeah, confirm send. There we are. Now, what this is doing is, whenever you do something that's probability-based, that is good for the investor, or higher probability that they could be right, there's a higher probability of them being right. With that, there's risk. That max loss is 718. So this also goes back to having built-in strategies of max loss. Now, if you take a look at this, we see the commission, okay? And this is really going to be a 282 credit, $282, less $1.30. And what we'll go ahead and do with that is we'll send that order, okay? Now, so trade number one is going long Amazon. The idea is that stock is kind of right at resistance. This is the focal point of what we're talking about here today. We're looking for stocks that have been maybe pushed down and maybe starting to reverse. This is kind of your classic little run to the upside, pull back, higher low, run to the upside, one day down, pop right back to the upside. A lot of people say, well, how do you find momentum? You're looking at it. The stocks that actually have, let's say, 3 red candles or less, then green candles, that is your classic sign of momentum. Now, James, you didn't pull up that discretionary sector. Shame on you. Well, if I actually pull up the discretionary sector, and I'm not a fan of this index, okay? If we pulled up the sector itself, this is what it shows. Not a fan of that, but if someone said the sector, feel free to pull up the sector you would look at for the discretionary sector, but that's what it is. If we look at Amazon, it's right there, okay? Now, it's twin cousin just super quick, okay? Now, we can't say that when we look at the analyze for just real quick, we go to, let's say, the fundamentals. It is going to be labeled in the discretionary sector, but man, we cannot say that's really the only thing it really does, okay? They also do artificial intelligence, database, analytics, machine learning, et cetera, advertising, ads, display, video advertising. Do we say everything? Almost everything, okay? So they do quite a bit. Now, but they're labeled mainly as consumer discretionary. Super quick on the Apple front. Not going to say a whole lot on this. We did see a brand new high on this today. Speaking of continuation, okay, kind of looks like your classic V pattern. When you look at that, just real quick, now we already have that position, so I'm not going to say anything to that. It's your classic flag, okay? Now here's the deal. When this went to the upside, green moving averages, and there was price falling down, an investor might say, oh, there's volatility. Remember, we want the volatility because the prices get knocked down to support, right? So some volatility is good. Some wind is good, okay? And now what you're going to see is that price got pushed down to 276, and then it ran up 50 points to the other direction. We need volatility, okay? It's what gives the bounces, crossovers, right? Now, let's also go to just real quick, Starbucks. Let's hold on that theme of discretionary for just a second. Now, here's the deal. Starbucks. Now, Starbucks CEO went to what? Chipotle CEO went to Starbucks, something like that. They crossed. Pull this up just real quick. Chipotle right there. Now, remember, we're still in discretionaries. I'm going to go back to Starbucks for just a second. Go back to the daily chart on this. We look at the daily chart on this. Now, again, some people might say, hey, there's not short-term opportunity, not short-term opportunity. We're like, wait, what? Not short-term opportunity. Now, it might just not be the short-term opportunity that maybe you normally look at. My classes that I teach have never focused on one sector. We've always said the same thing, 3 to 5 sector focus. We on the same page? I have never talked about just technology only. I just drew on the graph that if someone did that, which I've seen people do that, it's the most aggressive thing the investor could do to themselves. Okay? It's not really a balanced offensive strategy. It's what we call boom or bust. If that investor gets the technology right and technology goes up, they feel like a hero. If it goes down, well, they feel like the stock market just, just goes down. No, they did it to themselves. We want a balanced offensive attack. So that way, if we actually have other type of markets or we get some shifting, by the way, some shifting doesn't mean that the investor completely changes the strategy based on what we talked about. We said before is that if technology goes down, that doesn't mean energy goes down. Okay? Just because technology goes down doesn't mean discretionaries are all horrible, as we're seeing. Now, let's say the investor said, speaking of continuation and reversal, you're now seeing that if we looked at this previous high, we're right there. Now, I can hear someone saying, oh yeah, I'm going to wait to buy when we break out. What that fails to really understand is that now if we break out and we go to a brand new high, that same investor is going to say what? What are they going to say? Oh yeah, I'm going to buy when we pull back. Right? So this goes back to what we've talked about. Dollar cost averaging, building positions, putting capital to work, seeing that position is working. Now, on the chart, we kind of see that momentum pattern, right? 3 candles and then green. One candle, green. Two candles, green. Okay. One candle, green. One red candle, green. One red candle, green. This is literally, it's almost screaming to the investor. Momentum traders. Okay. Now, here's the deal. Is momentum is momentum like semiconductor stocks? The move in semiconductor stocks was the biggest moves we've seen in 30 years. Okay. So it's not always that. Okay. The movements we saw in semiconductors was historic. But if we could get some of these stocks to go up 5, 8 to 10% in the short term, 2, 3 days to 2, 3 weeks, that usually is more your classic type of momentum. Okay. Some of those semiconductors lately, they were going up, let's say 8, 10% in the morning. Okay. That's really, not always normal. Okay. Now, if we look at this chart, what I'm going to do is on this, and I'm going to right click, I'm going to go buy custom, and I'm going to go with OCO bracket. Now, wait, if we look at this chart, we got like kind of a basing pattern that's reversing, and it's also getting in the continuation. The area of resistance, everyone say it with me, resistance, okay? That resistance was right around 105. Today, getting above the 105. Remember when we talked about the midsection of the candles? Well, there's your big green candle. Guess what happened the very next day? Did not come perfectly down to that halfway line, about a third of the way. Guess what happened today? We actually went into the previous day, right near the close, intraday sell-off, intraday so far. So here's the deal. You need to change how you think about volatility. Volatility is the friend of the investor. Okay? Now, in the short term, if you have positions, positions get pushed down. Most of them, not all. But if you kind of know some things about how to protect some positions, might not be as bad as you maybe thinketh. But if the investor's looking to get in, that volatility, that's usually the opportunity set up. Now, we're going to right click on this chart. We're now actually going to go right click. We're going to go down to buy custom with the OCO bracket. And what I got is the 108.11. Let's move that to the current price, 108.19. Tell me where the target is and the stop underneath. If we were setting a stop underneath, we're going to set a stop underneath 102. Now, this also goes back to the comment initially, which we've tried to address here today, is the investors will tend to set really, really tight stops. A couple weeks ago, we hit stops quite aggressively. The investor tends to be doing it to themselves. If you're setting a stop 2 to 3% below the entry price, you're doing it to yourself. You're not allowing the stock to really fluctuate adequately to test support levels or moving averages. Most of the entries we talk about, we're risking 4, 5, 6, 7, 8% of the entry price. Okay. Now, speaking of that, let's kind of run those numbers, kind of see where we're at. We'll pull this back up, bring it right there. Let's kind of show it. What do we mean by that? Well, if we got in at 108.20, set a stop, let's say at 102, support was 102.16, based on what we just talked about. The stop, $100.12. We just hit that. You're now going to see the risk, dollar amount risk, $8. That's really not what we're getting after. What we're getting after, but we need that number. Okay, we're getting after that percent, 7.47. So if you had said, look, I'm going to set my stop tighter than probably inside 4% of the entry price, the investor, all they're doing is proving probabilities that the chances of them being stopped out and realizing and locking in losses, they're doing it to themselves. Okay. Notice I don't teach that. Okay. There's reasons why we talk about what we do. Okay. Now, what I'm now going to do is I'm going to put that stop right here. Now, tell me where that target is. Don't be shy. Okay. Dated GTC, dated GTC. So trade number one we talked about was Amazon. Trade number two we're actually talking about is Starbucks. Two discretionary stocks. Okay. Growth is not just technology. Okay. Now, if you look at this, if we back this chart off for just a second, if I just left it here, the idea is maybe could this be your classic Fibonacci where we go for where we had a resistance and we actually maybe extend. Okay. Now that extension, if we went to the 161, we got 115. If we went to, let's say, the 200, 121. And if we went to the, let's say, the 261, you got 129. Now, you might be thinking, well, James, which one is your favorite? The one that's higher price than where we are. Now, if we kind of said target-wise, midsection, probably would say right around 121.08. Do we know it's going to go there? Oh, I don't know that. Don't know if it's going to go there. We're going to put a target there. Okay? 121.08. Okay? Now, when we look at this, stop to the downside, let's verify that stop, $100.12. Dollar-wise, that's about $8. Percentage-wise of the entry price, that's 7.47. Okay? Most of our examples are probably going to be risking about 5 to 7%, 8% max. I mean, max of max, 10%. If we take 10%, that means our entry is probably late. Okay? Dated GTC, okay, go confirm and send. We'd have to position size this, but if you get the point, okay? Entry, target, stop. Okay, now, what I'm now going to do is let's kind of shift. Dean's been patiently waiting, haven't you, Dean? Okay, Dean's been saying, yeah, but what about those energies? Okay, now here's the deal. If we went back to that little sheet and kind of went back down to what we talked about initially, which is that energy sector. Now let's go to work here, okay? So we did two trades. Trade number one, Amazon, short put vertical. Trade number two, Starbucks, okay? Now, if we went back to the energy for just a sec, now remember, example number one, the investor might just say, James, I'm going to buy this sector, okay? That's an option to consider. Now, 2 weeks ago, we kind of talked about three stocks that were, let's say, we talked about, let's say, where some investors might say, hey, if the oil prices went down, you need the oil to make the gas, okay? Lower input costs might cause some of those producers of the gas, refiners, to maybe like have more inventory, okay? Now, some of these companies like Valero, I mean, what's wrong with the short-term move on this? Yeah, but I'm just used to looking at technology. Well, has this been horrible? Okay. What about MPC? Has that been horrible? So the moves are just in different sectors of growth. Okay. What's wrong here? Okay. If we pull up the third one? What's wrong here? Okay. So now here's the deal. The person that asked that question, am I saying that the person said they're only looking at technology? No, but I've done this at this company for 23 years. I've talked to thousands of investors over my time. I'm telling you, most of the investors, I think if I jump to a conclusion and saying tech, I'm probably right. Okay. Now, not saying this investor is doing that, but I'm saying that most investors are probably just thinking the growth is only tech, and that's not true. I think they forget energy. I think they forget base materials. Okay. I think if tech and discretionary actually go down, I think they forget about energy. Okay. Now, if we take a look at, let's say, some of these, and I want to go back to just, let's bring back up. So we already made mention of these three, but let's look at some different ones. What about OKE? Okay. OKE. What about COP? Okay. What about XOM? Now, what you're going to notice just real quick, we're going to do the example of OKE and XOM. Now, let's say the investor said, hey, we got all this stuff going on abroad, et cetera, et cetera. You know, does maybe the investor shift from medium to like go from short to medium to longer term? Okay. I mean, as you can probably tell by now, well, we're not thinking that. Okay. Now, someone else could. But those short-term moves are probably coming in other areas, okay? Now, if we looked at this just real quick, ExxonMobil. Now, this is your classic channel here. Now, I'm going to do this quick, okay? Stock trade. Now, the investor said, well, we have an area of resistance, multiple touches. If we get oil to go up and up and up and up, well, what does that do? Maybe it increases the expectation of what the earnings might be. They're building that in. They're not waiting just to the earnings. Okay. These investors are not foolish. They get it. Prices go up. The company might have a greater forecast of potential revenue and earnings per share. I mean, think about that, right? if they're selling that product at the current price and the price is going up and up and up and up, it doesn't take a mathematician to know that revenue might be higher. The revenue's higher, the earnings might be higher. Okay. Now, what I'm going to do is on this is I'm going to right click on this chart. We're going to go down to buy custom. I'm going to go with OCO bracket. Trade number 3. We're going to go 154. Now, Mike, do you like that poll right there? Okay. Disco ball and all. 154. Okay. Now, that's just the upper part of the channel. Now, if you look on the downside, remember, okay, how does someone kind of see your classic momentum, right? There's your 2 red candles. Now, remember, I said before, okay, if we get red candles, less than 3 days, but those red candles do not go down below the moving averages. If it doesn't go below the 10, the momentum's even stronger. If you don't go down below the 20, the momentum is still strong, but just not as red candles that don't fall below the 10. We did not fall below the 20-period moving average, and all of a sudden we get a little green candle, doink, and then we get the gap entry. Now, that wouldn't be that hard to understand that if you actually look at your routine, you go through kind of what's happening in the marketplace, in the pre-market, oil's up, la. Some of these energy stocks also might gap as well. Now, I have taught you many times what we call down day, close higher, gap. The gap, so that close higher gap, CHG. Close higher gap is really a 3-candle formation, okay? Where we actually get the close higher Friday, today gaps, and some investors try to take the entry off right at the morning. That could be in the pre-market or in the first 15, 30 minutes of the market, okay? Now, does that guarantee that the stock's in a gap to the upside and go up higher than that gap? No, it doesn't. It's just a potential entry setup, okay? Now, what I'm going to do is, let's say the investor says, I got an entry, target, I got a setup. Setup just means it's a setup. 154, the stop underneath, 137.88, okay? So if I go back up here, type this in, 137.88, is that support area? Okay. The stop is going to be right at 135.12. Now remember, we don't have, this class is not right at the open. Okay. If it's at the open, we could do this trade. We do the trades in the class. That way you can follow along in the paper money account in practice. Now, when we look at the entry price, 144.51-ish, percentage-wise, it's 6%. Okay, so it's not, when you run the numbers, it's not as high as you think it is. Okay, why is someone trying to buy here? Well, if someone thinks that dysfunction abroad might continue, the price of crude might go up, just hold up, maybe even go up more, and some of those stocks that have a relationship to that price might potentially appreciate. That's the idea. Now, the investor's not setting super tight stop losses. They're not over investing. They're not stacking the whole portfolio in that one odds. So that way, if that stuff goes away, they say my whole portfolio was in that area. Okay. Now, the biggest actually thing, what you'll find is in investing, it's usually not the market. It's what the investor did to themselves. And they overinvest in certain sectors. This does not mean the paper money portfolio is going to stack the whole portfolio in energy. It's going to have that 3 to 5 sector focus, and it's going to trade as it normally does and look for those potential opportunities. Now, so trade number 3, XOM. There it is right there. Now, I wanted to also go back to just real quick OKE for just a second. I'm just going to make mention of this, okay? When you look at OKE, that's kind of more your continuation where we really had some resistance right around 90.88. And that's a little horizontal break right there. Notice not too much in terms of the MACD dropping below 0, okay? Now, for the gentlemen that are let's actually see that. There was a question right here regarding this chart. If you want this chart right here, I send it to you in the chat. That way you can pull it up on your side. Keep an eye also on OKE. Okay, that's more of your basing, where it's also with that a continuation. Now, in wrapping up here, you're going to see that this is what it looks like in the weekly chart. You got maybe some potential upside room there. Keep an eye on OKE. That's not normally the first thing we talked about, but that's the one getting a little movement here today. Now, I'll also make mention if that kind of news happens continually abroad, keep an eye on some of the fertilizers, right? A lot of the fertilizer comes out of that region as well, and as that's kind of been stubbornly what's happened abroad, that fertilizer has also gone up. Fertilizer is underneath the umbrella of base materials. Okay, I'm out of my time here. I think the one thing that I'll just flash, Humana, okay, CI, Cigna, also ELV as well. Some of these healthcare names, those don't look bearish for some investors, right? You look at UNH, probably the softest, one of the stronger ones, really Humana and Cigna. Cigna being the, well, among other things, dental, among other things, okay? I'm out of my time here today. Now, remember with what we discussed here today, thank you for the question. Hopefully it was helpful as we kind of dissected that and broke down, did 3 or 4 trades with that kind of template in mind. Remember that Cameron May will be coming up next with covered calls and short puts. Thanks to Michael Fairborn in the chat for answering those questions. And also remember with what we discussed, it was done for example, illustrative purposes only. Hopefully what today was helpful, kind of doing Q&A on the spot. And to me, that's I think where it's can be very helpful. Now, remember with what we discussed, all investing involves risk, and also be aware of other strategies might help with trying to manage that risk. And stay tuned for Cameron May coming up next. Thanks so much. And don't forget to subscribe and also like this video and subscribe to the channel as well. Thanks so much. Take care. Bye-bye.